Hello everyone, welcome again to Hybrid Accounts YouTube channel, and today we're just going to proceed with the topic working capital management. The section today is on operating cycle and working capital ratios. That's what we're just going to focus on today, so just be ready. What is the cash operating cycle? All right, you call it cash operating cycle, you can call it working capital cycle, just like that. There are several names that you can put in here. All right, and what is that now? When speaking of the cash operating cycle, when you're doing a business, actually, let's say let's complicate it a bit. Let's say it's a manufacturing business. You will have to procure raw materials. You will have to produce, and then those finished goods I will have to stay in inventory until you get a customer, and then you sell them. If you sell them, actually, you could probably give your customers the time to pay, and if you give them a time to pay, so that's what will be there. If you give them the time to pay, then you will create the waiting time to receive the cash. But also those materials, I would have received those materials are on credit from suppliers. So maybe whatever you could have received labor supply actually on credit again, although this is not common. So that's why we say it's the length of time between the entity's cash outflow on raw materials, wages, and other expenditure, if possible, and the inflow of cash from the sale of goods. You're doing a business, you expect to make a cash outflow, but also expect to receive cash at some point in time. So that's what we call a cash operating cycle. So it really depends on whether you receive cash from customers before having to pay suppliers, or you would pay the suppliers first before receiving cash from customers. It really depends on the situation. So for a manufacturing business, we obtain the cash operating cycle as follows. Let me give you a very simple example. I think you know the meaning of working capital. Working capital is simply current assets minus current liabilities. Now, as for current assets, you will have cash. Cash, actually, you already have it, so you don't have time to wait. Then you have inventory. Then I'll have to add up all inventories, all time that will pass on inventory. Then I'll have trade receivables. Then I'll have to wait. I have to add the time to wait before receiving cash from customers. And then I'll have trade payables. That is very common. If you use trade payables also that you will be given some time to pay. So I'll have to list that. So you just take the time for current elements, you less the time for current liabilities. So that's why we say raw materials holding period. Then I would come and less this payables payment period. Most payables actually would come from inventory of purchases of raw materials, but it really depends. It could be supplied with labor on actually the same basis on credit. So I'll have to take raw materials holding period, and I have to less payables payment period, and then I have to add up the remaining period for the remaining assets of the working capital. So I just use one form of raw material, one form of inventory, which is raw material, and then I add another form of inventory that is work in progress holding period. When speaking of raw materials holding period, is the time that you have raw materials in the store and you do not use it. What work in progress, WIP means work in progress holding period is the time during which production process takes place. That means that you cannot sell something as long as it is still being made, right? And then I'll add a finished goods holding period. You may complete a good, you may complete the good may be finished, but no customers may be there available yet. So what you have to do, you also have to add up that time that goods stay in inventory after having been completed. All right. So that's also an important part. And then you are done with inventories, raw materials, work in progress, as well as finished goods. Then I just go to other forms of assets. Cash is also a current asset, but cash you do not have to wait for anything because the cash is yours. And then I have trade receivables. Let's just say receivables. So I'll have the receivables collection period, which most of the time the computers trade receivables. So this is the time that we give customers to pay us. So I'll receive the collection period, and then everything will be over. Then I'll have the cycle can be positive or negative. But simply speaking, if you add this item that relate to current assets and you less this one relating to current liability, that is payables, uh, you have the cash operating cycle. And the cash operating cycle can be positive or negative. What do I mean by this? If you say a negative cash operating cycle, now not be mistaken. Do not be mistaken. It's just as we just say, current assets equals to, working capital, net working capital equals to current assets minus current liabilities. Current assets may exceed current liability or may be exceeded by current liability. But here now, here this cash operating cycle is the sum of times on current assets minus times on current liabilities. So if the times on current assets exceed those on current liabilities, it will be positive, which is normally the case, but actually not necessarily that way. So if the cash operating cycle is positive, it means that if the cash operating cycle is positive, it means that you have to pay the suppliers on raw material, wages, and other expenditure before receiving cash from customers. That means you should be ready. That means you should be ready. You should have some other forms of financing current assets, let's say from long-term sources, because it will reach a point where you will be obliged to pay the suppliers while you actually have not received yet the cash from your customers. But when you speak of the negative cash operating cycle, it means that an entity receives cash from customers before having to pay suppliers. Of course, every entity would wish for that, right? You just go and borrow some materials. You do production, labor comes for free. Labor comes on credit. And then after being paid, and that's when you take that money and pay back and pay the suppliers. That will be very easy. And so there will be no need for extra finance from long-term sources. So that's why negative cash operating cycle be that way, and that's why I say no long-term funds are needed to provide for working capital. So that was the point here, all right? And now we can proceed. You can just go to the second step, and then we can just go to an example, right? Yeah. So here we are. These are the following are working capital ratios. Now, ratio analysis is the topic in its own, but I'll just go directly to some common ratios of working capital. We'll take a deeper look on the ratios topic itself. Then I have current ratio. What is a current ratio? From the normal ratio calculations, current ratio equals to current assets over current liabilities. All right. So you can just find out the proportion of current assets being financed by current liabilities. For example, a current ratio of 0.8, which is 80%, means that 80% this current ratio equals to current assets over current liabilities, right? The top one is current asset and the bottom one is current liabilities. So to describe it very well in a better way, I can just say that I'm speaking of current liabilities. So if it is 0.8 or 80%, it means that 80% of current liabilities will have to be paid. There is a time that you finance current liabilities, can finance current assets, but after financing current assets, they'll also have to be paid back from the same current assets. So the first point, I spoke of the percentage of current assets financed by current liabilities, but as for this ratio, we speak of this value down here. So it is the proportion of current liabilities that can be settled by using current assets. So an 80% current ratio means that 80% of current liabilities can be settled from current assets, but the rest can be settled from other sources or other, let's say, long-term assets. And then you have quick ratio. Quick ratio is just the same like as current ratio, but we just try to eliminate some current assets that we say they are less liquid, they are illiquid, we call them illiquid. That means we are not sure of whether we can convert them to cash easily, and usually we deduct the inventory figure. Then we have working capital turnover. This is equals to sales revenue over net working capital. You also see this as very important when you come to over and capitalization topics. So you take sales revenue over net working capital. Usually, when sales revenue increase, net working capital should also increase. They should go line in line, right? Because net working capital should also be used to finance the sales that you make. All right. So if it is very huge, we usually say that the company is. We usually say that the company is under problems, right? You say that it's just like we have just tried to force it. We are missing long-term funds. Don't worry about this. We'll see about overcapitalization and undercapitalization. All right, then let's just go to our main topic as we saw above there. We just say that I'll have to know the raw materials holding period from the topic above. Here, we just said it here. We just need to know these definitions: raw materials holding period, payables payment period, and so forth. So raw materials holding period, you just take the raw material inventory over cost of raw materials used, and then you multiply by 365 days, right? Usually, cost of raw materials used should form part of, let's say, just form that part, and then you'd multiply by 365 days. So that's what you'd actually have to do, right? Yes. So we can have the work in progress holding period. That would be the work in progress inventory over cost of work in progress incurred, and then you multiply by 365 days. And then you would have finished goods holding period, which is finished goods inventory over cost of sales. You multiply by 365 days. And then you remain with payables payment as well as payables payment period as well as the receivables collection period. Payables payment period. The time taken to pay the payables, you just take your payables over credit purchases, right? And then you multiply by 365. Not one thing, this payables payment period normally comes from raw materials for when it comes to manufacturing organization, but also it could come as for finished goods for merchandising firms, but also it could come from labor, let's say labor just giving service on credit. So you have to be careful over here. And then you have the receivables collection period, that is receivables over credit sales times 365 days. Don't worry about this. We explain this very well in the topic of ratio analysis. We're just trying to go through it. All right, let's go to an example and see what we can do, right? Yeah, so here is our example. The example says that the current assets and current liabilities of CSZ company, this is a CA question, at the end of March 2014 are as follows. These are the current assets and current liabilities, so you just have to take them down. We are given inventory is 5,700. Of course, the figures are in $1,000. Trade receivables, and then we are given the total of the current assets. And then you have trade payables, 2137. Overdraft, this is bank overdraft, 4682, and the sum of total current liabilities, which is 6819. And then you have the net current asset. That means the net working capital. Total current assets minus total current liabilities is 5456. And then we proceed here. For the year to end of March 2014, CSZ had domestic and foreign sales of $40 million, all on credit. So everything was actually on credit, these sales. And then while the cost of sales was $36 million, so you also have cost of sales here. Trade payables related to both to domestic as well as foreign suppliers. So you have the trade payables for both domestic and foreign suppliers. Then we are told for the year to the end of March 2015, that is the next year, CSZ company has forecast. We are at the end of March 2014, but we are forecasting for the next year. That will be the end of March 2015. CSZ company has forecast that credit sales will remain at $40 million, like above here, while the cost of sales will fall to 60% of sales. So I'll have the new cost of sales. The company expects current assets to consist of inventory and the trade receivables, just like above here, inventory and trade receivables, and the current liabilities to consist of trade payables and the company's overdraft, right? All right, we are further told that CSZ company also plans to achieve the following target working capital ratio values for the year to the end of March 2015. So you be careful here. Above here, we are given information for 31st March 2014, and down here, we are given information relating to 31st March 2015. Inventory days, 60 days, and trade receivable days, 75 days, trade payable days, 55 days, and actually current ratio are given 1.4 times. And what are we required to do now? A, calculate the working capital cycle, that is the cash collection cycle or cash conversion cycle of CSZ company at the end of March 2014, and discuss whether a working capital cycle should be positive or should be negative. So that's what you have to consider here. We'll start with this one, and this relates to March 2014. The figures for March 2014 are above here. Then you have B, calculate the target quick ratio, and and the target ratio or the sales net working capital ratio. And then we have C, discuss how the working capital financing policy of System would have changed from 2014 to 15. I've modified it a bit. And lastly, discuss the 3 internal methods which could be used by CSV to manage foreign currency transaction risk. I've modified it a bit too. Now I'll just go to part A, right? We will proceed with part B and C in other videos. So let's start with part A. We just need the working capital cycle, right? We know the formula for working capital cycle. What is the formula? This is our formula. We said that you just take inventory holding period, that could be raw material, work in progress, and finished goods, and then you have to add the receivables period, and then we less payment period. So I would just compute them directly. Now you need to go to our formulas, right? We just spoke of them. What is the inventory period? I think we spoke of this very, very well, right? We just spoke of this and we said that inventory holding period equals to, now here they have not specified which form of inventory is it. They just said inventory, right? So it becomes easy because you just take the normal inventory, assume that finished goods inventory, right? Yeah. So what that inventory figure that we are given? Inventory is there, you're told that inventory holding period, you can just use this finished goods holding period that you take inventory over cost of sales times 365 days. And for receivables over credit sales times 365, and for payables over credit purchases times 365 days. Usually, in case there is no credit purchases, you can just use cost of sales because we assume that opening inventory and the closing inventories are the same. So you have to be careful about that, right? So you can just go back, inventory holding period, inventory over cost of sales times 365 days. Now, in some questions, they could tell you a year contains 360 days, so you'd have to multiply by 360, or they could give you in monthly, so just be careful. So inventory, that is 5,700, over cost of sales, that is 26,000. You know, the figures were held in thousands here, right? If you just go to the question, I think you just find out this. Here we had inventory of 5,700. Here, had counted down up here, and then you had the cost of sale that were 26 million. So if you also hold the 1,000, you have 26,000. All right. So just come down here and plug into your formula, and you'd have 80 days. Then you come to trade receivable period, the same thing. Trade receivables over credit sales times 365 days. All right. What's the trade receivable from the question? Trade receivables we are given here, 6575 over sales. Sales were amounting to 40 million. Now, if you hold the zeros above, it will be only 40,000. So I just go and plug it down there as usual, right? So I would have it like this: 6575 over 40,000 times 365, and I would have 60 days. And then I just go to trade payables, the same. I just go back to my question and find out something like this. So I take trade payable, that is 2137 over credit purchases. Since no credit purchases figure is given, I would have to use cost of sales. All right? Yeah, so that's what I'll do. All right, so I could just go to part 4 here. I'll just go here and just write down the trade payables, that is 2137 over cost of sales. You know, it really depends on the situation because you could have used the forecast figures to compute inventory, and you could use that inventory to obtain credit purchase, but there is no really, there is no need, you know, ratios have no specific formulas. So just plug there and obtain 30 days, and then you can determine your working capital cycle, which we said we just take inventory holding period, that is 80, we add trade payables period 60 minus trade payables payment period. All right, in the formula, I deducted the 31st, so no problem. We have 110 days. What does this mean? This working capital, because the question asked whether should the working capital be positive or negative. For our case, the working capital cycle is positive, but as we see it, it's positive. What does it mean if it's positive? It means that the company has to pay suppliers 110 days before it receives cash from its customers. So the company has to be prepared. So the company can solely rely on the current liabilities, right? It should also rely on the long-term sources of finance. And lastly here, we say this represents a financing need, as I just told you, which could be funded from alternative sources. Now, Should the working capital cycle be negative or positive? From the question, we say that the negative working capital cycle, what does it mean? The negative working capital cycle means that you receive cash from customers before having to pay suppliers, which every entity I think would want that, right? Because it would need no external finance, it would need no extra finance. So a business such as a supermarket can have a negative working capital cycle. That's really a business like a supermarket. I could take you back to the question. The question said that discuss whether a working capital cycle should be positive or negative. That's why I'm just trying to explain it. So I just say that a business such as a supermarket can have a positive, a negative working capital cycle. For example, supermarket, normally in the supermarket, there won't be this trade receivable payment period. They do not sell on credit. So the left side here reduces, right? But also in the supermarket, they not manufacture. So this inventory period will be solely on the finished goods. So it will be reduced much more, right? But trade payables, goods, they can buy goods from suppliers on credit. So it could very well come to the point that this working capital cycle is negative. So it really depends. Working capital cycle being positive or negative depends on several factors. For example, nature of the business. Nature of the business, just for example, supermarket has that nature. Not a lot of inventory is held, and so we say that our inventory holding period is very low, and then no trade receivable payment period. Maybe they don't say goods on credit, all right, but they can secure goods on credit from suppliers. So it could depend on the nature of the business. Let's say nature of competition. If competition is very strong, they would have to find out ways to make sure that maybe the competition is very strong. Oh, let's just sell goods to some customers on credit because the competition is very strong. Or the choice of the entity. By the choice here, it could also mean anything. Let's say, for example, the working capital policy. I think you have seen about working capital policies. If the working capital policy maybe let's say it's a conservative one, that means you hold a lot of assets, it could be right that working capital cycle actually is positive, right? So that's all I had to explain here. And now, in the next session, I'll just go in the next video, but not this one. In the next videos, I'll just go and explain this part B, which will say calculate the target or quick ratio and the target ratio of self-net working capital at the end of March 2015. So this is what we'll do next. But as for now, I advise that you just go through this one, and if you have subscribed, you can subscribe right now for regular updates. Thank you very much, and until next time.